Well, hello everybody. It's Ken Winans and Stephanie Larson from Winans Investments. And as we get ready to enter the summertime and the post first quarter earning situation, we thought it'd be great to get together with you and just give you our input on everything. I'll go ahead and start, Steph, if that's okay.
Of course.
The good news is we really did have a very good earnings season. As I mentioned many times, this is a stock picker's market. There are companies that have figured out how to deal with the inflation. They have figured out what they have to do to keep their costs down, be able to make profits. And there was generally a lack of bad news. I mean, knock on wood, we don't do it all the time, but you know that our companies, the ones that we supported in very different industries, by the way, everything from manufacturing to healthcare, they were just people that or companies that did it well. So we're happy on that. I would also just say that there's been, as you know, I do ABC radio once a week, and I've been bringing up constantly, and I think the analogy best fits for how we see the rest of the year. Inflation is like rust on metal. Once it gets on a frame, it is very hard to get off. You know, any of us who have been around a boat trailer is a good example. You scrub it, you put goop all over it, you do everything you can to get rid of that rust. You never quite get it completely removed. And that's how I feel about the economy. For those of us who are old enough to remember the 70s, some of you in the audience can remember post-World War II. It just sticks. It's historically, as my analysis has shown, it's a 6 to 8 year cycle. I think that Stephanie and I are working off of the assumption that there will be no rate cuts this year.
We've discussed it, and I know in several videos I'd mentioned that they will. Now I'm starting to kind of lean in towards Ken's view that they probably won't.
You're trusting the old guy.
Yes. Aged well.
Yeah, like a good wine, a good vintage.
There you go.
But clearly we can navigate this world. But a couple of things that I would bring up. You've noticed that we've let cash build up in the portfolios. We have taken some profits in stocks that have clearly ran too far, too fast. Yeah. We're aware of taxes. I mean, I love it when people say, this is taxable. Yes, it is. We run a cost benefit analysis when we do take profits, and we just don't want to give back hard fought gains.
You will see that I did buy several equities though.
Yeah.
We didn't want too much cash to sit there. We've had a nice little mini rally the last week or so. We're keeping an eye on things. We're not broadly buying. We're very specific with what we're targeting, but we want to make sure that if the market has a little more oomph in it, that we're not sitting there watching it. We definitely have had a really strong start to the year, and we want to keep up our gains. So.
Exactly. Yeah. A couple other quick things. As you all know, that I'm a believer in seasonality to really pretty much every market, whether it's real estate, commodities, stocks, bonds. There is a seasonality to the ebbs and flows of money within investments. Yeah. So it's not a surprise that I really don't care what time frame you run. I've ran it back to the 1930s, but I'm looking at it more modern era. The U.S. stock market from May really to the end of September usually doesn't produce great bull market runs that go up forever. It's rare when they do, but it doesn't mean you sell everything and sit in cash till September. It just simply means that you got to be cognizant there can be a lot of volatility, especially with it being an election year. And remember, the election is not just the presidential election. We have congressional elections, Senate elections, and obviously state and local governments. So there's a lot of crosswinds in the air that can swing things.
Yeah, I think the difference will be from what we just did, which was trim, names that weren't doing well, took profits, and then also bought a few things. In the summertime, what you'll see is that if names are starting to act poorly, that we will again cut or remove them. But we might not be as aggressive to get back into the market until later on in the summer.
Yeah, well, and even going into the fall.
Yeah.
I know it can be a little trepidation in the market, especially going in front of an election.
Well, exactly. I was gonna say, even in the fall, I mean, with the election in November, I mean, I'm not saying we stay out of the market, but just, be really choosy with what we buy.
Yeah, absolutely. Yeah. A couple of quick things. Steph, you want to talk about what's going on in the bond world?
Yeah, so we had a slower start to the year in bond land. It picked up towards the end of the quarter, which was great, and in April, and it slowed down just a little bit again. The vacillation between the Fed, will they, won't they cut, is kind of have it a little bit stalled out, which is fine. I'm still finding good paper, and as I mentioned in the previous videos, we've had to extend maturity. I would say in the last couple of years, I could stick to 1 to 3 years and really get 6.5 to 7.5, and it wasn't that hard to do. And with the risk of rates coming down, you didn't want to go further. There was no need for it. Now you have to go really 3 to 5, maybe up to 7 or 8, which really puts you around like 32, 33 on maturity. To get the same kind of if you stay 1 to 3, you're gonna get about 5, 5.5. So I don't really want to cough up a couple hundred basis points just simply by not wanting to go out for a few years. I'm also working a little slower. You'll see if you have some cash in your portfolio, and I've been standing your portfolio up. It's taking me a little bit longer. Even when I see something I want, like today, I was buying a bond, and I had space for 750,000 of it. I only could get 2. So that doesn't mean that I'm not going to continue to work the order tomorrow. It's, the sellers aren't necessarily wanting to give up quality bonds. So it's definitely been a little bit of a challenge. Lack of supply, and then the cost of the bonds have gone up. I mean, just the spreads are much smaller. So it's been more challenging. It just means that you have to work harder. It doesn't mean that you can't find it. It doesn't mean you can't do it. You just have to work harder. If you really want it, you'll hustle, you'll get it. So
I'll just add a couple of things that I think that have changed quite a bit, and it has to be that I've been saying for many, many years. There's no such thing as a bond market. There are bond markets. Yep. They're plural. Mm-hmm. That means you have government bonds, foreign bonds, municipal bonds, corporate bonds, real estate related debt. You have it all over. Yeah, you have it all over. Here's one thing that I think is a trend that is pretty prevalent, and I think it's going to continue to wreak havoc within the bond world. I think there is a shift out of municipal bonds into corporates. Yeah. I think especially when you're, again, getting into the blue-red state migration issues, that those wealthy people who have left some of those blue states no longer need their municipal bonds.
Which also the blue states, the coastal states, New York and California, are the largest issuers of municipalities. To be fair, FYI, you guys didn't know that. So
yeah, exactly. So and I do think there's obviously serious concerns about the fiscal state of a lot of these states where they're running these massive budget deficits, and it might be a good time. I am one of those people who's migrating. I'm doing it for a little bit different reason.
You've migrated.
I have migrated, yes. I actually have a residence in Las Vegas. Any of you happen to be out to Vegas, please come by, see our office there. I did it for strategic reasons, besides personal, but we have now expanded into being 3 offices. We have an office in Salt Lake City. We have an office we've had one in Nevada for quite a while, and obviously the office in Novato, which is near the wine country of Northern California. But in analysis of our...
And we have a presence in LA.
Well, and that's part of what I was going to bring up is, as we looked at where our clients are, and with the changes in our company's expansion, it made sense for me to be more centralized, to be able to see our clients in Nevada, our clients in Southern California, and certainly with a large tranche of new clients in Utah. So it's for me to reposition where I am for the company and for all of you. Now, the office in Novato, Stephanie and the team are still here. Come by anytime. I will plan to be back here quarterly at a minimum. Certainly more so if needed. It's only an hour away by plane flight, so I will be there. But so yeah, just and by the way, I'm not retiring. This is not a ploy to go out and play more. I'm going to be working harder actually. But yeah, I am. No, it's. But no, I'm actually looking forward to it, and I know that it will be fun to have many of you. As I've already heard from many of you, you're going to come out to visit me in Vegas and write it off on your taxes as visiting your advisor. So I didn't give you any tax advice, but that's what people are trying to do it. A couple other quick things that are important to note. I would just say this, that we're trying to increase capability as we grow. It's trying to see all of you more often. We are still on that growth rate. I mean, any of you, especially with me now, spending more time in other places, if you have relatives or friends that you think might benefit from us learning more about our company and our services, and they want to meet me, well, now you have your opportunity. I'm now going to be much more available. I would also say too that we have long talked about wealth management, and with the guys that we have teamed up with in Salt Lake City, we now also offer that capability even more so than we have before. So this is a net benefit to our clients, not a deficit.
The wealth management piece also includes like planning and guidance with insurance and other capabilities. You know, when I talk about my job, I like to stay in my lane. I'm very good at what I do. Doesn't mean I don't know about insurance and stuff like that. It's just nothing I want to really play with. So it's very nice that we're bringing on these very experienced advisors. They've had a fantastic background coming from Merrill, and they are going to help us and help our clients with anything we need. So if you find that you do, we've had some requests already, and if anyone would like to talk to them about any planning, if you're nearing retirement, you want to see what that would kind of look like, or go through that kind of comprehensive analysis. I mean, that's what they're there for. We wanted to bring that capability and that quality to all of our clients. So we're very happy that we can now do that. They're great guys. You guys will really like them.
Yeah, at the end of the day, but the money is still being managed by Stephanie and I. It's not being outsourced. I've long time, the old Harry Truman say, the buck stops with me. We are a team. We are managing your money. It is not being outsourced anywhere else. There would be a legal requirement on our part to let you know if that ever did happen. I want to talk very quickly. As you all know, I'm doing a lot more with commodities. We are going to also, we have a Winans Commodities subsidiary that we run, and I'll be doing much more with that. But with that, one thing we talk about what's going on with the commodities. Many of them have had an amazing run. Again, inflation, there's a lot of ways to measure inflation. I don't particularly trust government statistics, so I like to get my hands dirty and do my own research. But when you have oil at above $80 a barrel, the geopolitical problems going on around the world, cocoa, any of you who've gone out to try to buy a milkshake lately or a candy bar might be in shock. Yeah, it's just crazy what's going on. And it is tied to drought conditions in West Africa. The point being, we've added a lot of capabilities in this company really in the last 4 to 5 years, and we will continue to do so. Many of you have asked if I'm going to write any more books. I still write for Forbes. I'm actually going to be updating Investment Atlas to include the pandemic and an inflation section and much more about commodities. But anyway, the point is there's a lot of exciting things that we're going to be doing over the remainder of this year, going into next year. And I can't be prouder of our team and how we've handled everything through a historical time. And I hope, generally speaking, you're all pretty happy. It's, you know, the merger with Schwab and TD threw a monkey wrench in a lot of administration. I know many of you are still struggling with, you know, K1s, 1099s, and all this stuff. You know, that world will calm down more as we go into, you know, 24, going into 2025. But again, there's just been a lot of balls that we've had to try to juggle here. And I think, as I say, I mean, I'm biased, of course. I love this company. It's like my child. But I'm very proud of this team and what we've accomplished. So listen, we're going to cut this short, Steph. Anything else you want to add? Or?
No, I think we're just going to kind of keep our heads down through the rest of this quarter. I can't believe it's May already. And then I'm glad we survived earnings with really no scares. We had 1 or 2 really good names actually pop for us, which was great. You'll see us active in your portfolios. If you have any questions, you know, throughout, we're always available to you. And again, if you had any ideas of maybe wanting to have any planning or wealth management, feel free to reach out at any time. Let us know. We'll connect you with our team.
And real quick, final thing. If you have not talked to us lately, okay, we have often said, I don't like doing big changes in portfolios. I believe in trying to stay the course, unless there's a reason to do so. But if you have not talked to either of us lately about the particulars of your portfolio, or there's been a change in things, Amy McGovern is trying to reach out to our clients. She does it annually every year. You know, it's not a sales job. We're trying to honestly find out what's going on in your life. You know, our client base has grown dramatically. We're still trying to keep that personalized service in place, because I know in a world where we all feel at times alienated, we want you to know that there's still living, breathing human beings here that want to talk to you. So if you've not talked to us in a while, please make a point to reach out to Amy, and we'll set a time that we can talk about your portfolio. But in the meantime, as they say in Britain, tally ho, here we go, let's just keep going
Okay.
and moving forward.
Well, when Ken's up in town again, we'll do another video, so not too long.
Absolutely. And then she and Amy will be doing
We'll do that.
periodic
Yeah,
things
check-ins.
as well. Anyway, I hope you all enjoy your summer, and we look forward to seeing you again in the not distant future. Take care now.
I guess.
Viva Las Vegas.